Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello. A lot to discuss today. We're going to run through, as always, the most important charts and themes that are going on in markets and investing. So, hello, 32 trillion. Let's start right there. And I think you probably know what I'm talking about. That is, of course, the US national debt, which crossed that 32 trillion mark for the first time. Not really a record that you that you want to brag about, but here we are. The debt ceiling, of course, was suspended. We talked about that. It had to be lifted. You can't have a ceiling when you spend much more money than you take in. And very quickly, just took a few weeks, $638 billion increase. And here we are above 32 trillion. Now, if we look at these national debt milestones, and I really, every time we cross one of these, I'll update this chart. And just the interesting thing in the recent years has, of course, been the frequency of these $1 trillion increases is becoming more and more frequent. And that's because we've borrowed just a huge amount of money in a very short period of time. And how much money? Well, at the end of 2019, we stood at about 23 trillion, and less than 4 years later, we're at 32 trillion in terms of the national debt. Just an enormous increase in a very short period of time. So when we're talking about the national debt, we can't just look at that $32 trillion number. You should adjust for the level of the economy. So if we were talking about an economy that was, let's say, 100 trillion in terms of output, that 32 trillion can't be viewed the same way as if as an economy that has 25 trillion in output, which is roughly where the U.S. economy is today. So the way I always look at it is as a percentage of GDP, and the trend there has been in one direction, and that's up. So 1980, 31% of GDP is the national debt. If we look at 2000, it rose to 58% of GDP, and today we're at 121% of GDP. And the natural question that people ask after seeing this is, well, at what level as a percentage of GDP does it really become a problem? And the truthful answer, of course, is no one knows. Every country is different. Many countries have problems at different levels of GDP. There's different factors that are going into that. But the right answer is you don't want to get close to that level, because at that point in time, then you're forced to do things that are going to be really painful. Ideally, you'll get things under control long before you get to that point. Now, what is the expectation in terms of, though, where this is going to trend in the next decade? Pretty much everyone's saying it's going to go higher. And the reason for that is that the increases in spending are outpacing the increases in economic growth. So that will increase the debt as a percentage of GDP. So as long as we're running $2 trillion budget deficits, which is where we are now, that percentage of GDP is going to continue to trend higher. So the expectation is we're going to see 130% of GDP at some point in the next decade. Of course, that could change. The policies could change, and so none of this is on a preset course. But if things don't change, we're gonna keep trending in that direction. Now, a lot of people like deficits. They may not say that out loud. Some of them do, and the reason they like it is in the short run, it actually provides a boost to economic output. So it makes you look good if you borrow money and you spend it, even if you're the government. So that's part of the GDP equation. So part of that is it becomes very difficult once you start spending money, borrowing and spending money, to cut back from that. Nobody wants to be the guy that comes in and says, wait a minute, let's be responsible here, not spend so much money. Well, that may be a good thing in the long run, but in the short run, that's going to cause a hit to economic output, to growth. It may even cause the economy to go into a recession, and no one wants to be blamed for that, which is why if you look at politicians, for the most part, they're arguing over how much to spend, not whether to balance the budget. It's really just a question of you're going to spend X amount or Y amount, because very few are willing to take the pain that's going to be associated with cutting spending dramatically. So where national debt becomes a problem in terms of servicing that debt usually has to do with the interest payments on the debt. And for a long time, as we discussed, everyone said, do not worry about the national debt because interest rates are so low. When you're servicing that debt, it's such a small percentage of GDP that you could safely ignore it. And very quickly over the last year, that equation is changing. We went from 2.4% of GDP, if you're looking at government interest payments, to 3.5%. That 1.1% jump in just a 1 year period is the largest 1 year jump that we've ever seen. And the expectation is this is going to continue to go up. We're going to continue to see bigger interest payments as long as interest rates remain elevated. We have more debt. You're going to have a bigger interest payment on that debt, and that's going to represent a higher and higher share of nominal GDP. And I suspect if this continues to increase in the coming years, this will become more and more of an issue that people argue over, simply because it's going to become a bigger share of what the government's spending money on. So if you're spending much more money on interest payments, you can't spend money elsewhere. And that's something that people actually care about, because they're not benefiting from the government spending money on interest payments. They want to spend money on things that benefit themselves. So maybe that'll be the point where they actually start to do something about it. Hopefully it'll be before that point, because at that point, as we talked about, I think it'll become more and more difficult. But none of this is on a preset course. I think that there are things that can be done. They just start to have to talk about it now and address it now, and recognize the problem that Social Security and Medicare are going to cause in the coming years, with the increase of the baby boomers retiring and entering into those programs. There simply isn't the money there that's going to be there to afford those programs. So unless you want to cut back 10 years from now significantly on those programs, you're going to have to start to make changes today. So let's shift gears here, talk about the housing market. This has become kind of like the movie Groundhog Day with Bill Murray. Wakes up every day, it's the same thing. And it's really the same thing in the housing market. We're just seeing the shortage get worse and worse here in the short term. So Redfin has data going back to 2012, and what they found is in the month of May, they saw the lowest level of homes for sale on record. So this only goes back to 2012, but 1.37 million homes for sale, significantly less than 2019 levels, where you're at over 2.2 million. And we've discussed this, but again, the biggest factor that's driving this shortage, why people aren't selling their homes, is they're locked into mortgage rates that are significantly lower, and they don't want to sell their house and have to get a new mortgage at a higher rate. In many cases, they wouldn't be able to afford that new home at a higher mortgage rate. So if you ask people who bought homes in 2019, 2020, 2021, could they afford the home they're living in at the current prices and current mortgage rates? And many of them will tell you no. So that's causing just this really collapse in activity and collapse in inventory. And if we look at existing home sales, we got another data point. Again, we had a down year over year in terms of the number of sales. So transactions have gone down and they've stayed down. And this is the longest down streak that we've had in terms of year over year declines in existing home sales since 2009. And of course, back then, that's when the last housing bubble burst, and you had just had a multi-year period of adjustment for the housing market. The difference here being is this inventory issue, much worse than it was back then. So if we look at prices, we're seeing prices improve, but just gradually. If we look at existing homes prices, the median price for sale was down 3% over the last year. That is the biggest year-over-year decline that we've seen since 2011. So you do have to go back over a decade. But given the run-up in prices that preceded this, a 3% decline year over year is not going to change anything in terms of affordability. And it's still very much unaffordable for the average person to afford the average home. And to illustrate this, and I do this every month, but we got to show this because it's just so unbelievable in terms of the numbers. Just 3 years ago, you're talking about a 3% mortgage rate, and the median home price was $284,000. Now you have a 30-year mortgage rate of more than double that rate from a few years ago, and you have a price that's significantly higher. So if you want to afford that same home today, the exact same home today, as you did 3 years ago, you have to pay 22,000 more in a down payment, which most people don't have, of course, and you have to pay 109% more in that monthly payment. So monthly payments more than doubled in a 3-year period. This is just for the average house, right? There's going to be differences across the country, but a doubling in a 3-year period is something we've simply never seen before. And needless to say, people's incomes did not double in the last 3 years. So something has to give. What's giving is if people want to buy a home today, they're just going to have to spend a much higher percentage of their income on that housing payment. So if we go and look at 2000 and 3 years ago, look at 2020, and we look at what percentage people are paying in terms of their housing payment. So this includes taxes, insurance, PMI. Doesn't include things like maintenance and repairs, which is, of course, important as well. But this study by the Atlanta Fed said that 28% of your income was needed to afford that median home price back 3 years ago in 2020. And today you're over 40%. So we're still at levels that we saw during the last housing bubble. It's gotten a little bit better over the last few months because mortgage rates were up around 7%, and now they've come down a little bit, and prices have come down a little bit, but nearly not enough. It's merely just a small adjustment. If we're talking about 3%, not big enough to make a dent in this. And for most people, even if they wanted to spend 40% of their income on a house, which definitely wouldn't be advisable if you're asking someone to do the math of that, that really is going to crowd out almost all other spending for people. I think what a lot of people say is you don't want to go above 30%. Some people more conservative say 25%. But when you get above 40%, it becomes unaffordable, and it becomes less likely that if you need a mortgage to buy a home, that you'll be approved for that home. So for all of these reasons, this is something that can't persist forever. And the question really is, how does this come down? Does it come down through mortgage rates coming down? Does it come down through home prices coming down? Some combination of this. Or does it simply come down very, very slowly through incomes rising? Right? And that's a possibility as well. We don't know the answer to that. The quickest way, of course, would be for prices to come down, but we're just not seeing enough inventory. It's a supply and demand equation in the short run. We're not seeing enough supply for prices to show any kind of meaningful decline. So what do we need? We need more building. And if you build it, they will come. I truly believe that if you build more houses in America, they will become more affordable and people will come to buy those homes. And I think very slowly we're starting to see that this transition. We've been talking about this for months here, but the trend has really continued in terms of increasing home builder confidence. And why is this important? When home builders are feeling more confident, they view conditions as good, they start to build more homes. And now we're back in positive territory in terms of confidence. And guess what? They're building more. If we look at housing starts, so new construction on homes, they're actually now up 6% year over year. And we saw a huge spike from April to May, over 20% spike. It's very rare that you see that in a given month. Hopefully this wasn't a one-off and we see this continue because if there's no existing homes that are for sale, people who, as we talked about, are in these mortgage rates that are much lower, they don't want to sell their home. Well, where's the supply going to come from? It has to come from new homes. So the more starts we see, the better. And as we've been discussing, the market always moves first. It always moves ahead of the actual data. And we've been saying for months, well, what's going on with this home construction ETF? You look at all the home builders, they're on fire. They're moving in one direction, even though the data seems like it's not good. Well, we said, well, this was on the expectation likely that we're going to start to see an increase in housing starts, that there is still demand and a lot of demand for new homes out there. And now we've seen a new all-time high in terms of this home construction ETF. It's recovered all of its losses from the peak in 2021. It went down 41%. Now we've seen a 69% increase new all-time high in the home construction ETF. So if the market is getting it right here, maybe it's not getting right, maybe it's overdone here, but if it is, then we should see continued strength in housing starts and more supply coming on the home front, and I think that would be a very good thing for the housing market. We need more supply. So let's talk about rate hiking cycles. YCharts did this great research study where they're looking at the last 4 rate hiking cycles for the Federal Reserve and what happened in terms of returns. And I went through this last year when the Fed started hiking rates, and my conclusion was, and I showed the different cycles, conclusion was there's no rhyme or reason that you cannot predict which asset class is going to do well during a rate hiking cycle. Thankfully, YCharts showed a similar thing here. And what they really showed during this latest Fed rate hiking cycle is something different than the other cycle. So every single rate hiking cycle that we've had, the last 4 here, 99 to 2000, 04 to 06, 2015 to 2018, and now 2022 to 2023, they've all had different leaders. Sometimes commodities led. This last one, commodities lagged. Sometimes growth did well, sometimes growth didn't do well, and so on and so forth. And I think the lesson here is a broader lesson than just the Fed hiking rates. If you did the Fed cutting rates, you probably see the same thing. And that lesson is the market's unpredictable. One cycle is not like another cycle. There's many different factors that go into the returns of various asset classes. And you can't say, even if you knew that the Fed was going to hike rates for this period of time, and no one knew it was going to be this long or this much, you couldn't say what asset classes would do the best or do the worst. And I think another interesting observation is not necessarily are you going to have big declines. In fact, the S&P 500 was up from 2015 to 2018 when they did this rate hike. In 04 to 06, the S&P 500 was up. 99 to 2000, S&P 500 was up. This time, S&P 500 was slightly down, but not, I think, as big at the end of the day as many people expected it to be. And conversely, as I've talked about, on the way down, if the Fed, let's say, starts cutting rates in a few months from now, a lot of people assume, well, that's got to be bullish for the markets. And Fed is easing policy, but that's not always the case. If we look at the period from 2007 to 2009, the Fed cut rates all the way down to 0 during that bear market, and the stock market still went down over 50%. And from March 2000 to the low in October 2002, the Fed cut rates down to 1%, and the market as well went down over 50%. So no clear relationship between what the Fed is doing and what various asset classes are doing. So be very careful if anyone tells you for sure this is what's going to happen if the Fed hikes rates or cuts rates. Nobody knows. You cannot predict that. The best thing you can do is have a diversified portfolio because of that uncertainty. So talking about investing during inflation, just want to give an update here. In terms of the S&P 500, long-term has been the single best hedge against inflation. Now, in the short run, anything can happen. 2022, we saw inflation very high. We saw stocks really get crushed last year. But if we look at longer periods, you're talking about decades, the best real hedge against inflation has been stocks. And this chart really illustrates why you need to invest to maintain your purchasing power over time. The purchasing power of the dollar is down over 50% in the last 30 years, while the S&P 500 after inflation, so after adjusting for inflation, is up 681%. So you're talking about 7% real return annualized per year for the stock market. Not a bad return over the last 30 years. But as you can see, this is not nearly always the case. You can go long periods where stocks don't keep pace with inflation, or they actually or underperform inflation. But if you're an investor for 20 or 30 years, historically, there hasn't been a better investment on average than a diversified equity portfolio. So let's talk about the economy here. This is an interesting piece from the Conference Board. Every month I've been talking about their leading economic index. And this time around, they said they made this prediction that the economy in the US is going to contract in Q3 2023, so third quarter of this year to the first quarter of 2024. They have a number of leading indicators they look at. As we've talked about, month after month, the leading index continues to go down. In May, it was the 14th consecutive month where this leading economic index was lower. As you can see, every time in the past it's been this low, there was eventually a recession in the US, and they're projecting that trend is going to continue. And if you look at the leading index components, what are really the two areas now that are not suggesting perhaps a downturn? Well, one would be the stock market, which of course has rallied significantly this year, and the other all of a sudden is the housing market, where building permits are perking up. So we're seeing, of course, those housing starts numbers and an increase in housing activity, the opposite of what we saw last year. So other than those two areas, we're still seeing that yield curve spread. We're seeing credit deterioration in terms of lending becoming tighter. And we're seeing another number of things in terms of new orders and ISM hours worked are down. So a number of factors saying we're going to see economic weakness, but in terms of predicting, is it going to happen in Q3 2023? That's very difficult to say. So that's what they're saying now, but they could always push it back. I think they were before this, they were predicting that there was going to be a recession in the second quarter, but they've now pushed that back to the third quarter. And in terms of the reasoning, they're saying it's going to happen due to continued tightness in monetary policy, which we'll talk about in a little bit, and lower government spending, which we already talked about. So is either of those going to happen? We know that higher interest rates are going to have an impact, or already have an impact in terms of retail sales and spending. The question is, what is the timing going to be to really drive the U.S. economy as a whole into a recession? So this is kind of the thing that's hanging out there. Is it a guarantee? No, but obviously the odds are to see some type of slowdown in terms of growth due to all of these leading indicators suggesting that, except for the stock market. So perhaps, as we talked about, stock market is right and these other areas are wrong. And you always have areas, even during a recession, that do well. So perhaps we have such a shortage of housing supply that the housing activity is going to improve during a recession. And you'll see that within every recession, you have these weird things going on where you're saying, well, that shouldn't happen during a recession, but it does every single time. Things don't move together 100%. Now, coming to that point about tighter monetary policy, every day these expectations are going to change. Powell gave a few speeches this week, and what he suggested was, perhaps there's going to be more rate hikes to get that rate of inflation down. So he wants to get inflation down to 2%. Why 2%? Who knows? That's the level that they want, and and perhaps they're going to have to hike rates more to get there. And for now, the market's saying that rate hike is going to occur in July, 74% probability. And they're saying then the Fed is going to keep rates there and cut rates in early next year in January 2024 back to 5%, and then keep cutting rates throughout the remainder of next year. Now, will that play out as the market is expecting? Who knows? Powell is looking for 2%. If you look at real-time inflation measures, we're almost there. If we look at Truflation's year-over-year inflation measure in the U.S., we're at 2.38%. That's the lowest level this year. If you remember, last June, we were over 12% for this metric. So we're heading already in the right direction. And my question would be, is if these numbers continue to trend in this direction at the July meeting, is the Fed really going to be forced to hike rates at that point? I don't think they're going to be forced to. I think they will have a decision where they could say, well, let's just push it off perhaps to September, but we'll see what happens when we get closer to that meeting. If you look at the U.S. inflation rate, again, would be another case to say the Fed could perhaps hold off another meeting before they think about hiking again. This is the trend here. We're likely to see 3.2% or perhaps even lower than that when we get the CPI report for June. Is the Fed going to hike rates again at 3.2% CPI when they They held rates at a 4% CPI. I'm not sure. The Fed could do whatever they want. They don't have to look at uh, the latest inflation data, but they're always talking about being data dependent and taking that new information. So I think if they want to pause here and wait to see the policy effects of the higher rates, they will have enough data to do that for sure. But if we look around the world, we're seeing again this interesting divide here, where again there's many developed market countries that are behind the curve still. Number of them hiked rates this week. If you look at the UK, they surprised market participants, 50 basis point hike to 5%. The expectation is they're going to continue to hike rates. CPI didn't come down last month, stayed elevated 8.7%. And the expectation is you're going to see more hikes there. Norway hiked rates again. Switzerland hiked rates again. The expectation from the ECB is we're going to see more rate hikes. They're up to 3.5%. So you have that on the one hand, and then you have China at the opposite end of the spectrum. China cut interest rates this week as people did expect, and while the rest of the world is tightening policy, China's easing, and people are suggesting that's because we're seeing a downturn in China. All of the data in China is suspect in my view. It's hard to rely on anything. But if you believe that their inflation rate is close to zero, and that is because of economic weakness, then that suggests that China could continue to ease policy from here, and that they're in a very different place than the rest of the world, especially in Europe, that has a higher inflation rate than their policy rate. So we'll see what happens there. But in the short term, barring some new additional news, we're going to see more rate hikes from the ECB and the Bank of England in the coming months. Now, as far as the U.S., again, we're over 1% above the inflation rate. A little bit of a different picture. U.S. and CPI lower than most of Europe, and the Fed funds rate is higher than many of those countries as well. So we were earlier to hike interest rates, and perhaps we're going to be earlier to hold and maybe even ease on the way back down. Now, interesting here, down at the bottom here, Turkey. If you remember, we've been talking about Turkey, kind of crazy moves they were making last year. They had pressure on the central bank to cut rates, even though inflation was exploding higher. The currency, Turkish lira, was absolutely collapsing. They finally now are reversing course here. They did a big interest rate hike up to 15%. And the expectation is that there will likely be more hikes to come. So we'll see what happens there. But the experiment of, I think, the suggestion that you could cut rates despite high inflation and we'll just see what happens. I think that's experiment is over. Now they're going to move in the opposite direction. Interestingly, in the short run, the Turkish lira fell even further after this interest rate hike. So it wasn't enough to, I think, calm markets just yet. And if you listen to their central bank leader there, what she said was essentially rate hikes are a good start, but that alone isn't going to bring the inflation rate down. They have to do something about the money supply. I think that was a very important point. Money supply growth in Turkey has been over 50% for some time now, and you cannot have that without high inflation. Of course, we saw a version of that in the US, but thankfully, we've reversed course and now our money supply is contracting. So let's talk about the downtown downturn. So the office market in many downtown areas around the country simply hasn't recovered, while many other areas have recovered from pre-pandemic levels. This is not one, and we've talked about the reason for this. There's simply many people have not gone back to work in the office every single day. So if you look at office building occupancy by city, way down from where we were in early 2020 before the start of the pandemic. It's gradually moving higher, but we kind of stalled here. And if we look at passenger trips, transit, and that has come up, but again, still well below 2019 levels. And interestingly, if we look at cell phone activity in downtown areas, again, a fraction of COVID levels, with San Francisco being the hardest hit by far. And the stock market has really priced this in and priced in a big divergence between the commercial real estate sector in the retail side and residential side versus real estate investment trust with downtown office exposure. You could see just a huge difference in terms of the rate of depreciation from 2020, with the office exposure down over 60% from that period of time. And I think this is going to continue to be an issue. I don't see how this is going to be resolved without more defaults in terms of the loans, without more pain in terms of price adjustments. I think it's just a simply early stages here, and while equity market participants aren't really talking about it, what I've noticed here is that regional banks have started moving down again. They never really benefited much from this tech renewed tech boom. Nasdaq 100 up over 36% year to date. Regional banks still down over 30% and slowly starting to move down again. Remember, they the smaller banks, the regional banks, have the biggest exposure to these commercial real estate loans, office sector in particular, and we just haven't seen yet, I think, some of how that's going to play out. Now, a number of factors, I guess, could change that. If interest rates were to come down, prices were to come back up, if all of a sudden office occupancy comes back up, but it doesn't seem in the short run that those are going to happen. So likely to see, I think, more pain for commercial real estate before things improve. So let's talk about the biggest stocks in the market in terms of market cap. And what I like to do from time to time is break down the S&P 500 in terms of not just market cap, but what are the biggest companies by net income, revenue, and employees. And often you'll see companies overlap, not so much in the number of employees, but often you'll see it. Companies that are the largest by market cap will also be the largest by earnings. Revenues, you have a little bit of a different picture, obviously, because you have Walmart's profit margins are very low versus a company like Microsoft has extremely high profit margins, and so they don't need the same level of revenue. But if we look at the biggest stocks, Apple and Microsoft, number one and number two, they're number one and number two in terms of profits, right? Google here, number three, and Google's number four in terms of profits. So often you see these connected in terms of earnings, and oftentimes, if not exact in terms of revenue, they're up there somewhere. Now, the two interesting companies that I think on this list that are very high in the market cap space are Nvidia, number five, Tesla, number six. But what you'll notice is you don't see them in either the highest net income categories or highest revenue categories. So what I tweeted out the other day is Nvidia has the fifth highest market cap in the S&P, but it's 132 in terms of revenue, 86 in terms of net income. Tesla's sixth highest market cap, 42nd in terms of revenue, 24th in terms of net income. So what that simply means, of course, is these companies are highly valued. Expectations are very high, so nobody is expecting these rankings 132 to stay there. They're expecting Nvidia to have much higher revenue, much higher net income over the next year. But the question is, as we've talked about many times in the last few weeks, have these expectations, particularly for Nvidia, gotten way ahead of in terms of where the market's pricing it? So is that $1 trillion market value already pricing in just phenomenal future growth? And we'll only know the answer to that in hindsight, but just an interesting observation there. And also interesting to see that, of course, Amazon's different than obviously other big tech companies in terms of has a huge number of employees, 1.5 million, but many of the other big tech companies can produce extremely high profits and have these huge market caps with much fewer employees. So the profit margins are driving that higher in terms of their valuations. You can kind of understand that they could just do more and produce more, particularly for software companies with fewer employees. So every bear market's different was kind of my mantra last year when whenever anyone would ask me, well, what's going to happen with this bear market? What could we compare it to? First thing you got to understand, every bear market's different. So as we were underway and started to look like, okay, this bear market is going to be perhaps a longer bear market than the ones we saw in recent history in terms of 2020, we only had a 1 month bear market, or 2018, it was just a few months, 2011, just a few months. This one was clearly different than those, and the two people we're comparing them to were the big ones that lasted a long time. That was, of course, 2007 to 2009 and 2000 to 2002. And so I just put together a chart here comparing the trajectory of each of these bear markets going back to the start. So from that January 2022, the current bear market was actually worse than either 07, 09, or 2000 to 2002 at its low point in last October. But since then, that enormous rally that we talked about, 27% rally in the S&P 500, now it looks very different in the opposite direction. So you have all of a sudden at its peak here last week, the S&P was only a little over 7% down from its prior high, which was very different than what we saw in terms of the 2000 to 2002 bear market at that point in time. And the 0709 bear market, interestingly, I think this might surprise some people, was already over by this point in time. So it had already bottomed. The March 2009 low was already in, and we started moving back higher. So does this mean a lot of people are using charts like this to say, well, this means that that the low is in, because this is different than other bear markets, and we've never seen this big of a rally this late in a bear market. So that means we're just going to go up to new highs. That certainly could happen, but we can't rule out, because every time is different, another move lower in the coming months. Perhaps people are going to be worried that the Fed might have to hike rates more than people are expecting today. Perhaps the recession fears will start to come through in terms of earnings expectations. Perhaps it'll be something else that no one's even talking about today. But that is a possibility as well. So using these comparables is I think, a good starting point to say, where are we in terms of context, in terms of bear markets? But you can't say definitively that because this looks different than these other two, that the bear market's over, and you can't say for sure that we won't have another leg down. Hopefully, we continue to move higher, but you should not be surprised if there's another move lower. It's already looked different, obviously, than these two from the October low, and it can certainly diverge from them going forward as well. And if we look at the volatility index, I would make a similar point there. The VIX actually closed below 13 this week. Pretty incredible. Lowest since January 2020. So very quickly, we've gone from a market with very high volatility throughout 2022. Never hit an extreme high point, but above 30 a number of times. And here we are below 13, lowest since January 2020. So we went back to those two long bear markets. And I said, what was the highest level of VIX that we saw with the bear market still ongoing? So we hadn't yet hit the lowest point in the bear market, and we had these bear market rallies where the VIX came down, and both of them were in the 16 area. So we never saw the VIX going this low with this bear market in the 2000 to 2002 bear market, or the 2007 2009 market. And once again, people might be using that to say that that means the bear market's over, but who knows? The VIX could spike higher tomorrow. We just don't know. So let's talk about being shaped by our experiences. This is an interesting one. Gallup puts out this poll asking the share of people in each age group with money invested in the stock market, and the only age group that showed an increase in percentage of people that had money invested in the stock market was this baby boomer group. And they suggested that the reason for that was that the baby boomers, many of them, started investing during the secular bull market that started in the early 1980s and saw the biggest run up to its peak in 2000 that we had ever seen, and perhaps will ever see in stock market history. So they were shaped by those experiences. They have a better association with it, and they suggested that's perhaps the reason why the baby boomers continue to brace stocks, even though many of them are entering retirement. And if we look at baby boomers as a share of wealth, just incredible in terms of the percentage of overall equity, corporate equities and mutual fund shares by generation. The vast majority still in that baby boomer generation, even as they enter retirement age. So sticking with it, stocks have done well for baby boomers. And if you contrast that probably with someone who started investing in 2007 or maybe 2000, they might have a different view of the stock market for sure. So we're all shaped by our experiences, particularly early experiences in terms of investments. And if it's a very good experience, we're more likely to embrace that. If it's a bad experience, we're more likely to view equities as a risky asset class. So let's end with something positive, as we always do. Supply chain is healing. A wonderful thing. The global supply chain pressure index that the New York Fed puts out recently hit its lowest levels on record. Data goes back to 1997. Awesome to see. What I like to look at in terms of supply chain is this freight index Freightos puts out, and that hit its lowest level since 2019. So kind of confirming this data, the supply chain issues that everyone was talking about a few years ago seem to be completely healed. That's an incredible thing. No one would have thought that was possible, going from really the worst supply chain issues that we've seen to very good supply chain issues in just a short period of time. Prices 88% lower from their peak. So hopefully this is a trend that continues. This is going to have an impact on inflation. And I'm sure the Fed is looking at this, but more importantly, you're going to see the impact of this in terms of all of the purchases that you're making. So wonderful to see. Hopefully it continues with that. We'll end it right there. Have a great weekend, everyone. Thanks for watching. If you like the content, as always, subscribe to the channel, and I'll see you next time.